Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, June 20th, and you're tuned into On Trend. So we'll start with our long-short review. I want to play a game, What If You Knew? We're going to look at Chinese and semiconductor ETFs. This is a revisit. Got some semiconductor and software stocks setting up, and finally some stocks to watch. All right, so we're going to start off with the S&P 500 because it is my main market barometer. If the S&P 500 is doing okay, then that means I'm on the lookout for bullish setups in individual ETFs and stocks. And as far as I'm concerned, the S&P 500, the bulk of the evidence turned bullish there in mid-February when my breadth table turned net bullish. And then we had the 20-day moving average crossing above the 200-day there in early March. So once those two pieces were in place, you had an uptrend. After a big move, we had like this, 26% advance. We had a normal garden variety correction, 7% or so. And then we had this big surge. And now we stalled for 5 days and we're continuing higher. And it looks like we're going to get a break above 29.50 and a new all-time high. Now, I don't mark resistance levels in uptrends, as I said before, because you expect resistance levels to be broken. All right. Now, if you're into patterns, there's a pattern taking shape here. It's called a cup with handle, and there is a rim resistance around 29.50. And here is the cup portion, and there is the handle. And if you get a breakout there at 29.50, that opens the door to much higher prices. Now, personally, I'm not into upside targets. I'm really not into this kind of a pattern, except for individual stocks and when it's a little bit tighter, smaller. But, the bulk of the evidence is bullish, so we should not be surprised to see a move above 29.50. And by the way, a move above 29.50 to a new high just affirms what we already know. The longer-term trend is up. It's not making things better. It's just affirming what already is. So reviewing the short-term situation for SPY, QQQ, and IWM, first we had this 4-candlestick reversal there with the gap down, the stall, and the gap up. Then we had the breakout of the channel. Then we had the move above the 50-day. We stalled for 5 days just above the 50-day. And again, I don't use the 50-day, which is the dotted line there, as a support or resistance level for anything but the S&P 500 and SPY because it doesn't work that great as a support or resistance level outside of SPY and the S&P 500. But it did hold, and now we're continuing higher. So with this 50-day and these lows here and adding a little buffer, I can mark support at 285, and I think we're clearly in a short-term uptrend as long as 285 holds. Then we look at QQQ. We can see a similar situation. There we have the channel breakout, a little bit of a stall, and continuing higher, and adding a buffer. I'll mark support in that 180, 182 area. And then looking at IWM, it also broke out and stalled above the breakout zone and is continuing higher. So I'll put support at 150. So there you have 3 short-term support levels for SPY, QQQ, and IWM to watch going forward as the first levels. So let's go back in time. What if it was, say, January 1st, and I had told you that the 7 to 10-year Treasury bond ETF would have a massive rally in 2019, and it would be up substantially by June. And what if I told you that the 10-year Treasury yield would fall to around 2%, which it has? And what if I told you that TLT would have this massive rally as well, and it would be up double digits in 2019 as it is right now, and the 30-year yield would be at a 52-week low, which it is now? What if you had this information ahead of time on January 1st of this year? And then what if I told you the REIT sector would be the best performing sector of the 11 sectors with a 24.5% gain, and it would hit a 52-week high? What if I also told you that at the end of June, 3 of the 11 sectors would hit new highs on the price charts? REITs, utilities, and staples, and the other 8 would not be hitting new highs. What if I told you that at the beginning of January? Could you make a prophecy for the broader market is what I'm getting at. What if I told you utilities would be at 52-week highs and leading up 15.4% in 2019? And then what if I told you staples, which, has been a nightmare to trade over the last 3 years. You can see it's just been flat above and below that 54 level with big swings. But it did hit a 52-week high, and it is up double digits in 2019. So if you had this information ahead of time, could you have made money in the stock market? Could you have shorted the stock market and made money? Well, clearly not, because if you had known this information ahead of time, you probably would have thought, oh man, it's going to be a rough year for the stock market if all this money is moving into the bond market. There you can see all this money is moving into the bond market in 2019. So the stock market must be going to go down. I better make some bearish bets and buy some puts in January. Well, if you had done that in January, you wouldn't be doing very good now, because I showed you the S&P 500 is within 1% of a 52-week high. Sure, small caps are lagging, but IWM is still up double digits year to date. But the point I want to make here is don't over extrapolate. Okay, don't think just because bonds are going up, the stock market can't go up. Don't think just because the defensive sectors are leading that the S&P 500 cannot go up. All right, the S&P 500 is the main market barometer, and if you want to know what it's doing, you need to break down that S&P 500 itself. You need to look at the sectors, and as long as the weight of the evidence is net bullish for the index, then that is positive for the broader market. And as we saw, the S&P 500 is probably going to hit a new all-time high this week. It's within 1%. So we can't extrapolate information like small caps are lagging, that's bad for the market. Bonds are surging, that's bad for the market. Defense is leading, that's bad for the market. No, you need to look at the S&P 500 for what it is, the S&P 500, and look at these other ones separately. All right, look at each individual asset separately. So my main point is, if you're interested in gold, look at gold. You don't need to be looking at another asset to have an opinion on gold. Because look, the dollar's up 3% this year and gold is up 5.5%. Similarly, bonds are up 10%. But that doesn't mean you have to be bearish on stocks, because you can see the S&P is up 18%. And you can see these defensive groups are up big, but that doesn't necessarily mean that the stock market as a whole is going to be weak. So keep an open mind and look at things separately. The other piece of general advice that I could give you is forget about the Fed, forget about the economic statistics coming out, forget about the employment report, forget about the tariff wars, forget about the tanker or whatever crisis they're having in Iraq, and watch the price charts, because that is where the real action is. So if we look at semiconductors, this is XSD, the broader base semiconductor SPDR. And you can see here that it's getting a nice bounce off that retracement zone. So it came down very hard, but there's the 200-day. There's that 50 to 62% retracement zone. There's kind of a broken resistance turn support zone. So it all came together in this 72, 74 area, and we got a really strong bounce there in semiconductors. So that's net positive. We look at the SOX, which is more market cap weighted, so it's going to favor the likes of Intel, Applied Materials, and Texas Instruments. Those are some of the bigger weightings in that ETF. A similar picture, you have kind of a resistance zone there turning into support. You get into that 50 to 62% retracement zone and the 200-day, and we get this big surge. So I would say as long as we hold 179 on a closing basis, that is net positive for the market. Now I want to do an update on China, because China is making a move. Here is the ASHR, which is the 300 China A-shares ETF. It's a broad-based ETF. And whereas the next one I'll show you, the FXI, is 50 large cap stocks. So this is a more, this is an idea of how the average stock in China is performing. And if we look at this chart here, we can see kind of a resistance level turning into support around 25. And then we came into this 50 to 62% retracement zone and started firming. We had a number of lows there as support came in. And now we've got a little breakout in the making with the upturn that we've seen over the past 2 weeks. So it looks like China is ready to resume its bigger uptrend. And if we look at FXI, now you can see that it underperformed ASHR on the decline because it got below that 61.8% retracement, but it did manage to firm around 40, and it did hold above these lows. So it had some higher lows working there. But perhaps most important, look at that surge over the last 2 days and that breakout. And I highlighted China last week, and it looks like one of my Fibonacci retracements is a little off. So I can kind of tighten that up there and make it match that low and that high. But, China's breaking out. Semiconductors are bouncing off support. That's got to be a net positive, I would think. Now, before we look at some individual semiconductor stocks, I want to review what I would call the tech-related industry group ETFs. This is the Cyber ETF, SIBR. It's the cybersecurity ETF from First Trust. And on each of these charts, I've got the 200-day for reference, and I've got the Fibonacci retracements tool. And the Fibonacci retracements are drawn from that December low to that April high. So you can see here, this one retraced 38 to 50%. And we know semiconductors retraced more. They got into that 50 to 62%. So these ETFs that retraced less, like less than 38%, are actually holding up well. This one held up better than semiconductors. But you can see we've got a breakout in the works here with cyber breaking above that trend line. And we can mark a support level based on these June lows here to watch going forward. And then we look at Hack, which is the other cybersecurity ETF. We can see that it got down to the 50% retracement line, a little bit deeper than cyber. And it did get a breakout there as well. And I'll mark support at 38.5. Now we look at FinTech. All right, you wonder why KBE and KRE, the banking ETFs, look so bad? Well, maybe it's because FinTech looks so good. I've got the iPay ETF coming up as well, but they are taking the business away from banks, basically. So if you look at this ETF, you can see it didn't even get to the 38% retracement. It didn't even really have a retracement. It just consolidated after this big gain. So it had that big gain from December until April and then kind of consolidated and got a breakout here, and it hit a new high intraday in June and a closing high yesterday. So it's clearly one of the leaders here. We look at the First Trust Internet ETF, and it's looking more like the cybersecurity ETFs. And you can see we've got a 38 to 52% retracement, so a normal retracement. And then you got the breakout there and mark support around 140. And here's mobile payments, okay, iPay. And you can see here that we've got that massive move from December until April, and then a really small consolidation, even a higher low from early May to late May, and of course a breakout there and a new high. So iPay is the strongest of this group. FinTech FINX is the second strongest of this group. And then we look at software IGV. It's one of the stronger ones. It did dip into that 38 to 50% retracement, but it held the 200-day. So relative to the other ones, it held up better on this pullback here. And we got a breakout working here. So I'd mark support there at 110. And then cloud computing. you can see that it had this deep pullback, but it did hold above the 200-day, reverse near that 38% retracement, and is getting a breakout here. So now I want to look at some semiconductor stocks, and these are very highly correlated stocks, as far as, they're kind of like utilities and REITs. Semiconductors really have a high correlation together. They tend to move in the same direction, both up and down. So we're going to look at some of those stocks. And to do that, I'm going to use the ACP, the Advanced Chart Platform here at Stock Charts. It's a new feature that we've rolled out to our members. And I need to make some adjustments to get the chart looking how I would like it. This is just a chart of the Dow Industrials. It's the default chart when you pull this up. And so what I want is I just want to put RSI down below. So I would just drag that indicator down below. I'm going to click on that indicator name MACD because I want to delete it. I don't want MACD. Believe it or not, I don't want volume either. I really don't use volume. Just read Flash Boys and Dark Pools and you'll understand why I don't use volume that much. And for type, I'll leave it at candlesticks for now, and I'll leave it at daily. And then I can use this little collapse button there to collapse the sidebar and make for a bigger chart. Now this button here up at the top right, the scrunch button, all right, when I click on that and then I grab my mouse wheel, I can scroll out and see a longer time frame, or I can scroll in and see more detail as I like. And it's interesting here, if you scrunch out, you can see that big resistance zone there for the Dow Industrials. Look at that. It's been bumping up against this 26,700 area or so since 2018, early 2018. But like, SPY, it does have this potential cup with handle brewing there. So let's get to the semiconductor stocks because I want to see some of these individual charts and how they're setting up. This is Applied Materials, and it is a semiconductor equipment stock here. And I'm going to go ahead and remove that 200-day moving average, or the 50-day. I'm going to go ahead and close that. So if I click on the 50-day and click delete, because I like to keep my charts as clean as possible. So I can scroll out a little bit here to get some detailed analysis. And what I'm going to do here is show you it's looking bullish for Applied Materials. You had a resistance zone there that turned into a support zone. And we got a pullback here, but it looks like we've got a breakout now. I will change that so that little annotation sticks. But you can see we had a big move up, kind of a consolidation. We had a breakout and a deep pullback, but now we're breaking out or turning back up again. And we can mark support here at 40, and I would be bullish on Applied Materials as long as 40 holds. Now the next one is ASML. It's also a semiconductor equipment stock, and I'm going to scrunch this up a little bit more there, a little bit less actually. And again, we can see a similar situation happening here. You have a resistance level that was broken, and then you kind of have that consolidation there that turns into, that marks kind of a support. So you basically have resistance here, and then you have this consolidation with resistance and support. And so that's a zone there. And you can see ASML came to that zone and is getting a bounce. So we had this, falling wedge forming. We got a gap up. Yeah, that looks like an island reversal there, but I think the bigger picture is still bullish. And we got this big move up the day before and a little bit of strength yesterday. But I think you can mark support at this week's low. And if you break that, then you have to go back to the drawing board here for ASML. Next up is MCHP, which is Microchip Technology. And as you can see, these charts, they all look very, very similar in that, you've got this big move up And then you've got this sharp pullback. And you can also see that we've got a broken resistance zone that kind of turns into a support zone. So we had this big move up, pull back to that newly found support zone that was confirmed with that March low and now the May lows. And then we have a little bit of a breakout, hard throwback, but we're bouncing now. And I'd say if we close below 80, then we have to reevaluate this microchip technology trade here. NXPI is the next semiconductor I want to highlight. Again, look at how these patterns just totally look like each other. There's kind of a resistance zone turning into support. You can see in that 87 area, 87, 88, and we had a very hard decline, a bounce, a sharp pullback, and then another bounce. So I would say as long as you hold above 90, that next NXP is looking okay. All of these are kind of at a make or break point because you're getting that bounce off support. And if it fails, that's going to be negative for semiconductors. And that would reflect negatively on the technology sector. Next up is Texas Instruments. And we can see again, there's resistance. Need to change because I don't want the arrow there. There is resistance turning support. So you can see the breakout, test, test, test. And Texas Instruments had one of the shallower pullbacks, and it's getting a bounce. And again, all of these you can use last week's low to mark support. And if we go below that low, then perhaps we have some trouble. And Xilinx is the last one. I'll do ADI as well. Now, Xilinx was clearly one of the market leaders there. Had this massive advance from 70 to 140. It doubled, and then it retraced around half with this decline. And you can see that this decline, there's resistance, held right above that resistance zone and right above the rising 200-day, and it's back on the rise here. So you could mark support there again at last week's low for Xilinx. And finally, ADI. And ADI was holding up a lot better on the pullback. And because if you look here, okay, ADI had the similar characteristics here. You had the breakout with the big move up. You had the hard decline back to the breakout zone. And then you had this surge. Now, what makes ADI different is this part right here. Look how shallow that pullback was. All right, where the other ETFs had filled this gap and stocks, ADI held up much better during that pullback period. And look at it surging again. So ADI is one of the leaders, if not the leader among this group I just showed you. Now, I've been looking at relatively short-term charts. So I was using candlesticks, and it was an arithmetic chart. And I want to make a couple other adjustments here. So I'm going to click on the chart options, and I'm going to change this to log. And then in other settings, I'm going to remove that show current price because I'm not interested in that. And for type, I'm going to move to open, high, low, close bars. And then you can scroll out and get a lot of perspective here. Here is Autodesk. And if you're looking at a long-term chart, it is usually better to use logarithmic charts here. But if you look at Autodesk, it had this nice big consolidation and then the breakout. And I will go in a little bit more short term, and we can see that we have this resistance zone there that was broken, and it turns into a support zone. So we've had this big move up, we've come back to support, we bounced once, had a little throwback, and now we're bouncing again. So AutoZone is part of a strong software group, and this one looks like it is ready to go to new highs. So Oracle came out and reported and beat expectations, and the stock moved up. We saw that big move in Adobe as well. And here is Salesforce.com, CRM. And this was clearly one of the success stories in 2017 as it more than doubled from the beginning of 2017 until the third quarter of, or the 18 months later in 2018, it had doubled. So it's gone into a consolidation phase here. But what caught my eye here was you had this kind of support zone, and it looked like we broke it, and then we rallied right back, and we had this gap up even. So that was a big bounce back. So that's a failed support break, basically. And we're firming around that 200-day and that old support zone there. And we got a nice bounce yesterday. So Salesforce could be ready to continue higher, and it's part of a strong software group. Intuit is also looking like it wants to hit a new high. There you can see the break from the resistance, and then we had the pullback that held above the breakout zone, and that's probably about a 38% retracement if you measure from this advance down to here. You can kind of eyeball these retracements because, they're not like you're going to find a reversal at 38.2% exactly. It's just kind of when you get into that zone around 50%, give or take 10%, you start looking for a potential reversal. And we can see here that Intuit got support there in that 235, 240 area. And we can see it's breaking above a trend line here and looking like it wants to go higher as well. All right, now I've got 4 stocks that are setting up with bullish continuation patterns. And, this is pretty much my bread and butter pattern. I'm looking for a long-term uptrend. I'm looking for a pullback within that uptrend. I'm not looking for big reversal patterns. I'm not looking to pick bottoms. And if you can see with Amatec here, it gets the big breakout there. It hits 52-week highs in April. And then it's got what looks like a little falling flag or a wedge. And we've got a wedge breakout working. Then if we look at Fastenal, which is an industrial stock here, and we can see similar but not exactly, but we have, broken resistance turning into support there. We had this massive advance in December, and you can see this retracement, and it's about 50%. It's back to broken resistance turn support, and we get the bounce off support. A little bit of a throwback last week, but resuming higher. So I think this one, as long as it holds 31 and the market holds, the S&P holds its 50-day, I would expect it to move higher as well. Fiserv is an interesting play here because, again, there you see broken resistance turning into support. So we get the breakout and we pull back to the breakout zone. And we kind of consolidated with a very volatile triangle here, but we're breaking out of that triangle and very close to new highs. And finally, PPL shows a similar pattern here, in that you have the new high, and then we have this correction, and it's not a picture-perfect flag or a wedge, but clearly we're breaking out and poised to continue an uptrend. So that concludes this edition of On Trend. Thanks very much for tuning in, and have a great day.